Every investment that you're ever going to make deserves a certain time when you need to analyze it and make your decision whether to invest in it or not invest in it. So a certain amount of understanding of how you analyze your investment is very, very important for each of us, especially when it comes to things in the equity market space. The type of investment analysis is different from doing it for non-equity oriented products. Today we're going to look at what kind of an analysis one would do while investing into, say, an equity mutual fund or an equity stock, as the case may be, at a very broad level. What are the kind of investment analysis that one needs to do or one can do? Broadly, I would say there are two approaches that one can look at when one is zeroing in on one investment. The first is what we call a bottom-up approach. What do we mean by bottom-up approach? We pick a particular stock or a particular idea and then look at analyzing it in depth. It could be you're studying the product, the marketing plan of the company, you're studying the management, the governance of that company, you're finding out the future market potential of that company's products and growth potential. All of these, when you study and analyze, and then you pick a company that to you looks like a multi-bagger, then you will screen it for other companies within the same industry. How does this company fit within that space? And last, you would then do the analysis of finding out whether how that industry is going to perform vis-a-vis the other industry. This is what we call a bottom-up stock picking approach. You pick the stock, you do your homework, you're completely convinced about that story, and then you do the filters on other companies in the same industry and then the same industry among the various other industries. This is what we call a bottom-up approach. You're going from bottom upwards. But there is also another approach which is diametrically opposite, which is, yes, rightfully called the top-down approach. In the top-down approach, you would approach the same thing from an industry perspective first. So if you have a set of money, and let's understand this, profits are nothing but allocation of your money among various opportunities. If you misallocate wrongly, you're not going to make money. So it's extremely important to get your allocation right. So the top-down approach is about allocating your capital to the best industry. So let's take an example. We are faced with a certain recession in the Western world. Budget cuts have happened and so on and so forth. So the IT companies which have predominantly been focusing on the Western world and they've been serving it are unfortunately having a difficult time. Their clients aren't increasing budgets, aren't signing new contracts in a hurry, so on and so forth, because everybody is tightening their belts. So from that perspective, between two opportunities of something like an IT and some other industry which in India is booming, I would go with an India booming story currently at this point in time. Makes a lot of sense. So this is just an example. So you analyze from different opportunities and find out which are the industries that are either doing already well or likely to do really well in the medium to short term over the next 3 to 5 years, and then go with that as the first point. So you zero in on those exciting industries and then go into which are the best companies within that industry where your money must go. You analyze different companies, and then from out of those many choices, you pick one single company. The reason you pick that company is because it has a stellar track record of performance, it has a management that is impeccable, it has a market share, or it has a moat, unique advantage that other competitors don't have. So if you have all these lined up, then that's the company where you must put your money, or that's the segment of the market where your money must play. Now, this approach of coming from the industry down to the company and then making your investment is called a top-down approach. Either a bottom-up or a top-down approach. Any approach works as long as you follow the fundamental principles of analysis. You also can do between a technical analysis and a fundamental analysis. Now, what is technical analysis? What is fundamental analysis? Technical analysis looks at a stock or a company's performance on the stock market from a trend perspective. It's trying to identify how the past trend has been to extrapolate to the future trend. So let's say, as an example, the last 50-day average of a particular stock is on a downward curve as compared to the last 200-day average, then you know that the stock is going to hit some headwinds and it's likely to come down. So you would rather sell now than hold on to it. On the contrary, as compared to the last 200-day average, the last 50-day average of a stock is on an upward curve, then you know that the stock is swinging upwards. There is some positive activity in that stock. There's greater demand. The technical analysis tries to understand the demand supply on the ground for a particular stock and use that information in decision making. So that's really the purpose of technical analysis, and you can use it to make your investment decision whether you want to buy a particular stock or sell a particular stock at any given point in time. That's technical analysis. Of course, a lot of science behind it, lot of trend analytics, lot of statistics goes behind it, but at a very broad level, that is technical analysis. Now, fundamental analysis is all about getting your hands dirty, going into the data and finding out how that individual stock is. What is the intrinsic value of that stock? Let's say the stock is trading at 250 rupees and that intrinsic value of that stock is, say, almost 200 rupees. The stock is almost trading at 1:1 to its book value. Then it begs to move to the next level and say it's a great company to buy, as long as it fulfills various other criteria. It's got a great management, its dealers speak highly of it, its customers want more and more of its products. If all these things tick off for you, then it may be a great stock to buy. Doing all these analysis at the company level, getting data to validate whether you should buy a particular stock from a financial and general perspective is called fundamental analysis. Now, fundamental analysis will tell you whether you should invest or disinvest in a particular stock or not. That answer you will get. Technical analysis will tell you when you should invest and when you should sell. What and when of a stock is what you will get from both technical and fundamental. Now, is it technical analysis or fundamental? It's a combination of two. Fundamental helps you identify the stock. Technical analysis helps you time when you should buy or when you should sell. That's really the magic of having both these approaches. How do you use a fundamental approach, a fundamental stock analysis? You can use it either through a top-down or a bottom-up approach. Both these approaches help. Both these will give you great outcomes. But if you're willing and if you're looking at getting your investments right, you will need to follow some of these patterns and do some due diligence so that your investments can give you good returns. What are the 4 aspects of investment analysis that one needs to understand if they want to make a smart investment?